This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter looks at outsourcing, shared services, and disruptive technology. First of all, outsourcing. And outsourcing is where a company decides not to do something itself, but essentially to subcontract that to another company. It could be manufacturing, it could be design, it could be running an advertising campaign, it could be outsourcing internal audit. Many areas of company activity can be outsourced. Has become quite popular. And here are some of the potential advantages of outsourcing. First of all, it allows a company or an organization to focus on its core activities. The core activities are really what allows it to be particularly successful, to get competitive advantage. It's where the company is really uniquely good. And this is really where it adds value and what it has to concentrate on and look after really well. A lot of the other activities, accounting, running the internet site, maybe internal audit, are kind of necessary evils almost. We have to do it, but these activities do not of themselves generate profit. They can be a bit of a nuisance. And why should management spend its valuable time in fretting about the internet site or fretting about accounting or internal audit or even human resources if it could outsource those to other very competent, skilled companies and then just concentrate itself on what it's particularly good at and where it particularly adds value? There can be a thought that outsourcing costs money, is more expensive than doing something yourself, but it needn't be. If an outsourced company, for example, concentrates, specializes in, say, running sales ledgers, then it gets really slick at looking after receivables. It's got large computers, a very efficient infrastructure, and it just looks after that bit of the business very efficiently. And it may be cheaper to actually outsource to a specialist than to try to do something yourself in a more amateurish, less efficient sort of way. It can give cost certainty. You can sign an outsourcing contract for maybe 3-5 years, something like that, and you know that every year what that cost is going to be. Whereas if something is insourced, then maybe you have got errors, problems, maybe you have to recruit somebody in to fix something or to deal with some special aspect that existing staff can't deal with, and the cost may well be more or uncertain. Cost restructuring. If you outsource, then those costs potentially become variable. If you don't need to buy raw materials in, if you don't need to buy even finished goods in, you don't buy them in. Whereas if you're making something yourself, then of course you've got all the overheads of the factory. More of the costs tend to be fixed if you do something yourself, tend to be variable if you outsource, and you may well prefer costs to be variable, particularly if you think that maybe the market is going to go down and the market's a little bit uncertain, because then your costs go down as well as your sales. Cutting edge expertise. You are maybe a manufacturer of furniture, and also you're trying to run the internet and the e-sales, e-commerce site and so on. Well, where are you going to get the expertise to do that? You will have maybe adequate expertise, but it might be better to outsource that to a specialist internet provider, a specialist company which writes really good and looking internet sites and so on. And that may bring better quality. The IT company who's running your internet site will be, or ought to be, really well geared up in terms of security, in terms of how good the design is and the reliability of the site and so on. Whereas it's not your main business, you're maybe a bit more amateurish than they are, and the quality may not be as good. Risk transference. So if you have transferred your internet site to a third-party provider and the site is hacked, well, you're not going to have to pay for that. They should have had the firewalls and proper security there to keep your site and the data it contains, customers' data and so on, secure. So this is risk transference, one of the 4 ways that we saw very early on of dealing with risk. You can avoid it, you can reduce it, you can transfer it, and you can simply accept it. So this is risk transference. And capacity management. Maybe you don't have the capacity to do something yourself, or maybe the demand goes up and down very, very wildly, and if you were to keep enough, let's say, manufacturing resource to deal with the busy periods, then a lot of the time they're going to be idle. Whereas if you keep only enough people to deal with the quiet periods, you're not going to be able to gear up quickly enough to deal with the busy periods. Again, subcontracting all or part of, for example, manufacturing, anyway, passes the problem to the outsourcer. And anyway, they may be much larger. They may be able to absorb very busy periods in your production schedule without it hardly bothering them at all. Potential disadvantages that we might have in this. There can be unexpected costs. Depending on the contract, really, or what happens after the contract and it comes to renewal, and they put up the prices again, and it can actually they can have quite a grip on you there. If you've outsourced all of your IT and you suddenly decide that these people are too expensive and you want to bring it back, well, you haven't got the computers, you haven't got the staff, you haven't even got the data. It's all with the outsourcer. They can really have almost trapped you a little bit into having to accept higher prices. You are, of course, relying on the outsourcer to produce quality goods and deliver quality services, because your customers don't know that you're outsourcing. They are just buying from you. And if you are unlucky, maybe the company to which you are outsourcing lets you down and the quality slips, and you're the one who gets the blame for it. Non-congruent objectives. Again, if we take the IT example, they want really just to be doing the same thing month after month after month, never having to change the software. You, however, might want to bring new features into the software or into the internet site. And of course that causes them bother. I mean, you might pay them to do that, but really it's there could be this lack of congruence. You want a fairly dynamic internet site. They, however, tend to want a fairly static, no-bother internet site. Success depends on the third party. They, of course, have your data. They have your methods of production. They have your design diagrams. There is, as a last point says, a confidentiality issue there. They have all of this data. But also your success depends on how good they are with that, how efficient they are at producing the reports you want, how good they are at delivering the goods on time, how good they are at responding to orders coming in. And if they are a bit sluggish, a bit careless, then you may begin to suffer. Now, Harmon's process strategy matrix is a very useful diagram when it comes to trying to decide which tasks we should actually think of subcontracting. And what it looks at are these two elements here. It looks at the strategic importance of the activity. And basically, strategic importance is something which tends to give you your ability to make profit. So this is really what gives you the profit. It's what you are particularly good at, what you're particularly valued for by your customers. It's really where you add value. If it's not of strategic importance, this is what I kind of call a necessary evil. We have to do it. We have to do our tax, for example, but it's not creating any profits. The other axis is complexity, and also usually in here you see what's called dynamism. Is the process complex, and does it change rapidly, or is it very static? Now what it suggests is, if you have an activity, a process, which is dull, which has to be done, which is not helping to make profit, and saying here that's fairly complex, fairly dynamic, like maybe doing your tax computations in a company, then maybe the best thing to do is to outsource that. Of course, many companies do. Rather than having their own tax expertise inside, they say maybe to their auditors or an outside firm of tax experts, you do our tax computation. You're the one who's staying up with the latest legislation and tax. You know how we can make use of tax losses or whatever is going on there. And it's really too complex and moves too quickly to automate. So we'll outsource it to you rather than bothering with it ourselves. Top right, we have something which is strategically very important and which changes a lot. What we're looking at here, BPR, is business process reengineering. So we have improvement of the process. Business process reengineering is kind of radical rethink of the process, maybe doing something entirely different. But we're saying here we are not going to outsource. The problem is if you outsource something which is of strategic importance to you, you're really divulging the secret of your success to other people, and that is not wise. So best to do it yourself. So if you take, for example, Apple outsources manufacturing, but there's nothing particularly common or particularly secret in manufacturing. You can take an iPhone apart and see all the parts in it and so on. The real secret of Apple's success is really design and bringing online radical new products which other people haven't thought about. And to outsource that, if you could outsource something which is so nebulous really, the power of design and thinking of new products, then anyone could do it. Next, we have where something is of low strategic importance and is really stable and pretty simple. What we're suggesting there is you automate or outsource, and something here would be like the receivables ledger. No one in their right mind is going to do a receivables ledger manually. It's a nuisance really doing those invoices, getting those statements out, sending out letters to people if they're a bit slow in paying and so on. You're going to automate it. Or, of course, this is a sort of thing which is outsourced to an invoice factor. A factor is a company. Basically, you give your sales ledger to that company, the accounts receivable to that company, and they look after all of the basically the invoicing, the receipt of money, the credit control, and so on. They will even advance you some of the money a bit earlier, and so on. It's just made for outsourcing. And finally, we have something which is stable, which is relatively simple. It's of strategic importance, so automate it. It can be a little bit difficult to think of an example in here, something which is very stable and simple, yet of strategic importance. And maybe a sort of a example might be airfares. So when you look up an airfare, say Ryanair or Vueling or Lufthansa, any airline company, you know that the fares go up and down. And sometimes they go up and down maybe several times in a day. You've probably been disappointed. You look at a fare in the morning, you look in the afternoon, it's gone up. Now what the companies are doing is they are continually monitoring how many people are looking at that flight. They're monitoring how many people are booked on that flight. They're monitoring other companies' airfares, competitors' airfares, and they're continually juggling the fares up and down. It obviously has to be automated. There is not somebody behind the scenes saying, I'm going to add $10 to that fare. These happen thousands of times a day. But it's also secret. Because if I was Ryanair and I knew how, let's say, EasyJet adjusted its fares, then I could kind of preempt them, really. If I know they will tend to put up their fares if I do this, then I can kind of maybe trick them. And I will get a competitive advantage if I know how they're going to vary their fares in any particular set of circumstances. So airline companies guard these protocols, if you like, guard these processing methods very, very jealously indeed. They do not want other people to know how they change fares. And so they're going to keep that in-house. There'll be no outsourcing at all. And no, there's no outsourcing in this bit at all. So anything which is regarded as having high strategic importance, we keep in-house. Little subject, commoditisation of business processes and outsourcing here. It's really saying, well, what is it easy to outsource? And it's easy to outsource, let's say, by large manufacturing or something. If I wanted to outsource to somebody the manufacturing of this pen, then I will give them engineering diagrams. I will specify the colour, in terms of Pantones or something like that. I will specify the type of plastic and so on which is used in the pen or the pencil. And it's very easy for me to define the product I want them to make. What we're talking about here is not defining a product, but really defining a service. For example, a service of maintaining an internet site or an IT department. So if I say to somebody, I want you to run my IT, what do we mean by that? What does it include? It probably includes security. It probably includes day-to-day processing. But does it include, say, the development of better software, the development of slicker internet sites and so on? I would have to stipulate, how many hours per day it was running, length of breakdowns and so on there. When you begin outsourcing a service, it is harder to pin down exactly what you're getting for your money. And all we're saying here is if you could get to a kind of common language where this could be commoditized. So if I said I want to outsource my IT, everybody has a common understanding of what that means. And if they have a common understanding of what that means, what that entails, then what you'll be able to do is to compare different suppliers on price, because we know they're all kind of doing the same, probably to the same service standards and quality levels. And if you've got several people giving the same service, then they tend to compete on price, and I was going to bring the price down eventually. But if you can't standardize exactly what's been outsourced, it gives room for people to vary the price, and the person who's more expensive, when you go to them and say you're the most expensive, they can say, but I'm better than the cheap ones, I'm more reliable, better quality, better security, whatever it's going to be, and that tends to keep prices high. So what's important here is to know what we're outsourcing, to have performance standards and management standards and so on. So really we know what we're getting for our money. Shared services. Shared service is an idea which has come into its own really with really the rise of really very good, very cheap and very fast communication systems, typically on networks. So here, for example, we have a firm of nationwide accountants. And they've got a head office and 5 regional offices. Now, traditionally, accountants, they fill in timesheets and so on. And based on the timesheet, that's what you're going to invoice your client. Traditionally, each one of these offices would have looked after its own accounting, really. The timesheets would have gone to somebody in each office. They would have typed them in, coded them in. They would have produced invoices for each of these clients at the end of various periods. They would chase the clients who get the cash coming in. They do the reconciliations of the bank statement and the receivables accounts and so on. There was an awful lot of duplication of effort and not great economies of scale. You're going to have a big computer in all of these places, probably a big accounting team in all of these offices, so on. What shared services simply does is to say we're going to have our accounting system or IT system or marketing, whatever it is, let's keep it with accounting. We're going to have just one of them. And now when, say, somebody in Regional Office 1 fills in their timesheets, that data is transmitted to the regional office which keeps the accounting service. So you got all this data coming down here, and this allows these shared service departments to produce the invoices, and then they will be looking after the receivables ledger and credit control and so on. They'll be dealing with the receipts and the banking coming in, and I suppose from time to time there'll be a report going back saying how your clients have paid up, or don't do anything more for them because you seem not to be paying at all. So what we're getting here, this accounting service in here, is simply shared between each of these offices and the head office. And we're getting economies of scale. It makes it much more efficient to do that, especially if you can locate these accounting services or centralized services, shared services, somewhat cheaper. So it would be, say in the UK, not maybe make a lot of sense to have the accounting services based in London, because the rental of office space in London is high. People, by and large, get higher salaries in London and so on. Put it in a provincial office with lower rents, lower salaries, and get economies of scale. You're going to do much better. Finally, a word on disruptive technologies. We have, I think, already mentioned the idea of strategic drift, where slowly, what's happening in the market, the environment and so on, separates from what you're actually doing, and you find yourself surprisingly irrelevant. And then you have to have a flurry of activity, try to make yourself relevant, or if you can't do that, probably it's the end of your organization. Disruptive technology is not a slow, gradual, imperceptible change. It is a bang of a change, where suddenly something out of the blue comes along and changes the whole competitive landscape. Examples of this, recently, iTunes. Think what iTunes has done to the music business, to the production and sale of CDs. Netflix. Think what Netflix, the downloading of films or television series on demand, think what that has done to traditional television services, where you kind of got what they wanted to give you when they wanted to give it to you. Think of the impact of social media, Facebook, for example, Instagram. Think what it's done to traditional advertising. More and more advertising is moving from newspapers onto social media. Think what it's doing for, let's say, it allows people to track and to predict what users of social media might be interested in. Another example, Airbnb. Airbnb, where people can rent their houses or apartments basically to tourists. Very disruptive of the hotel industry. The hotel industry complains that these landlords don't have to generally charge sales tax, VAT for example. They also suspect that these landlords may be evading tax. And they also complain that the houses or apartments to which these tourists are now going do not have to meet the stringent safety and fire regulations that proper hotels have to. But it's really shaken up the hotel industry. And finally, there's fintech, financial technology. For example, traditionally, the way borrowing and lending worked was through a bank. So you maybe have 20 people who place a deposit in a bank, and what the bank does, it's got that money sitting there. What the bank can do is to lend all of that to a particular customer. And the bank looks after the security and so on. The bank ensures that if one of these 20 wants their money out kind of quickly, then the bank can kind of accommodate that. So it's a very useful middleman, really, in matching up small depositors who may only want to put their money on deposit for a short time to, say, a large borrower who may want the money for 5 years. Fintech, in one of the examples it does is to put borrowers and lenders directly in touch with each other. So if I want to deposit some money, rather than putting it in a bank, I can lend it directly to a company who wants to borrow money. It's a kind of matchmaking service. The idea would be that without the bank intermediate requiring a cut of the transaction costs, is that I earn better interest and the borrower has to pay less interest. There are, of course, certain dangers within it. How do I know the person to whom I'm lending the money is trustworthy? Who's doing the credit checking? What happens if I want my money back faster? But there's an awful lot of kind of automation which can take place within fintech. If I want my money back, it can maybe find somebody else who wants to put their money in to replace that so that the borrower can keep their money going, basically. It can also work with kind of investments, where instead of having to go to a unit trust or investment trust to hold a portfolio of investments, there are fintech services which allow you basically to construct your own tailor-made portfolio of investments, and it will email you if it thinks that maybe you ought to change the balance of that, depending on your risk profile, and so on. So this bypassing of traditional third-party financial companies is really what fintech is about.